Welcome back to the continuing lecture in investment analysis. Now, we need to talk about the security market line, and this is nothing new. We've been talking about security uh, market line even from the previous chapter. I've been pointing out the differences between uh, CML and SML, right? CAL and CML. CML is basically the CAL of the market portfolio. Now, and the security market line is representing it graphs the relationship between expected return and beta. So it graphs the excess return as function of beta, right? And interesting thing is, so let's take a look at the security market line. The idea is, now in this graph, the vertical axis is the expected return, not the excess return, right? And which means it starts from the risk-free return, right? The vertical intercept is the risk-free return. And if the vertical intercept is not, if this is vertical axis is the excess return, then the security market line should start from zero. In other words, then there should be no risk-free return, because there's got to be no because it's excess return, and excess return of the market portfolio is zero when beta is zero, right? Or when exit, I'm sorry, when the but when the market excess return is zero. But it's the same thing. I mean, in a security market line, it's the horizontal axis is beta. But if beta is zero, then it has to be zero, right? Anything in the right-hand side of the equation, either the variable or the coefficient, if either the variable or the coefficient is zero, then the left-hand side will have to be zero anyway, right? Now, so think about it. If the beta is 1, that's when the market, that's when that's basically the beta of the market portfolio. No matter what, the beta of the market portfolio is 1 because it's the correlation with of the market with itself. So a correlation with self correlation is always 1. There cannot be anything else. And we can tell, and at that point, expected return is 14. So then what does that tell you? The excess return is 8%, right? Now, also, because this is predicting, because this security market line is, simply telling you that everything, all returns can be explained by beta, right? In other words, everything is systematic The only risk is the systematic risk. So if as long as you have beta, uh, the expected return of any stock is explained by uh, beta, right? So uh, at if the beta is 1.2, then if the stock is fairly or justly priced, then it should be simply the function of the beta. So uh, the return should be 15.6%. Uh, so basically, if the stock is fairly priced, right, in equilibrium, fairly priced means it's in equilibrium, then all the returns of the stocks will have to lie. I mean, and the stocks will vary only in its beta value, right? They will all have to lie exactly on uh, the straight line. Uh, but then, uh, but the reality is not like that. I mean, that means it's uh, the assumption was that the stock is fairly priced, and then it will be uh, everything is explained by beta. But look, the reality is that sometimes there are abnormal returns, and the abnormal returns are captured by alpha. I mean, the stock's abnormal returns, right? For example, when, and of course, that's why uh, we want to identify that stocks with alpha. I've been telling you, it's hunt for alpha, right? But again, so if beta is 1.2, this is what it should be. 15.6% return is what it should be. What it should, when we say so, it should be, it should be like this. What does that mean? That's an ideal situation, right? It's an ideal situation. But uh, in reality, the return was 7%, right? When beta was 1.2. What does that mean? Um, uh, there was an abnormal return of 1.4%, right? 1.4% abnormal return. So, how would you end up in an positive abnormal return? Um, uh, how would you, what would make you result? What would make the stock result in an positive abnormal return? There's only one explanation. It's not fairly priced, right? It's not fairly priced. Meaning, so then, uh, if it is not fairly priced, then is it? What does that mean? It's underpriced or undervalued. If the stock is undervalued, right? You're buying that. What does that mean? If the stock is undervalued, you're buying it cheaper. If you're buying it cheaper, the return would be higher. Makes sense? So, security market, of course, one thing you can benefit from security market line is you can identify a stock's alpha, and you can identify uh, uh, undervalued stock or overvalued stock. So think about it. If the actual return was something like the stock's beta was 1.2, and if the actual return was at this point, suppose it is 14%. Right? Suppose it was at 14%. What does that mean? This stock is overpriced, overvalued, right? If it is, come on, it's overpriced, right? And yeah, and since we are only, capm is only uh, expressing, capm is only showing the expected return on the left-hand side, not the excess return, right? That alpha is captured on the of the stock is, alpha of the stock is, represented or shown on in the right-hand side of the equation. And the right-hand side would already have risk-free return, right? Uh, and plus the alpha, right? And so this specification, right? Uh, again, if it is not mispriced, right, then alpha would be 0, right? So alpha can be, oh, yeah, this is not either this is always a mind-boggling thing. Two Roman numerals, right? Lowercase 3. Doesn't look nice. Hey, you know what I'm trying to show 3 possible cases, right? Alpha being positive, alpha being 0, and alpha small. Okay, I'll have to live with it. Okay, it's better not to waste time. And of course, this is fairly priced. And then if it is 0, if it is positive, underpriced, undervalued. If it is negative, overvalued, right? And, okay, so and the capm is being used very widely, right? Because it's got a uh, as I said, is theoretically very uh, powerful and solid, right? Regardless of the precision or accuracy of its actual. And there are a lot of critique about CAPM is that it is not very accurate. Um, no, it may not be accurate in the short run. I mean, in the short run, CAPM is not a short run uh, forecast model. It's an equilibrium long run forecast model, right? And equilibrium is hard to come by. Equilibrium is only a long run phenomenon, and long run in economics is um, uh, something like steady state when there is no longer uh, the market force that would tip it off the equilibrium anytime soon. In other words, there's no uh, uh, shortage or no uh, surplus or shortage in demand or supply. I mean, uh, long run equilibrium is basically a not a trivial thing, right? It's not a frivolous a short-term phenomenon. It's a long-term thing. So because the long-term itself is the long-term equilibrium itself is something hard to come by, right? Um, the accuracy, you cannot just judge the accuracy based on the short-term forecast, right? Anyway, um, uh, in investing, right, investment management, CAPM is widely used because the security market line is used as the benchmark for fair return on risky asset. And you can tell whether it is overvalued or undervalued. And of course, anything undervalued is a buy target. Anything overvalued is a sell target, right? And especially if you don't own that, if you don't have that stock, then it's a short sell target for short sell, right? Now it's also used for capital budgeting, right? Security market line provides a cutoff internal rate of return or hurdle rate for internal projects. Okay, internal projects. So CAPM result is used as the benchmark for in, cutoff point for internal rate of return. So any internal rate of return of the project that is higher will be accepted, any lower will be rejected. Now, in a regulated industry such as natural monopoly, is generally natural monopoly. I spent a good deal of time on explaining natural monopoly. Utilities are natural monopolies. Public, transit, mass transit, like MTA is natural monopoly. Cable TV, also TV and internet, natural monopoly. And these industries need to be regulated. Why? Because obviously we understand if it is monopoly and they can just jack up the price. If they're not regulated, they can just jack up the price any way they want. I mean, think about it. We are all held hostage, just like MTA. Everyone has to use MTA to commute, but it's monopoly. If MTA hikes the fare, MTA fare hike. I mean, when I first came to New York, subway ride. I mean, there was my first graduate school was in Denver, Colorado, and that was back in 1990s, early, late 80s, early 90s. And that was my second graduate school, actually, because that was my for second master's. My first undergrad and first master's I did in Seoul, South Korea, and then then for my PhD, I came to New York, and that was mid 1990s. And the subway was like 75 cents, 50 cents, 75 cents. I forgot it, and we had a token at the time, I think it was a token, yes, subway. It was almost like 30 years ago. So. And then, whenever they raised the fare, what can you do? I mean, you are almost like, held hostage to the fare hike because it's a monopoly. I mean, otherwise you have to, if MTA raises, the fare, the only other alternative is take a cab. I mean, in the early days, of course, the bus, you couldn't, transfer between MTA buses and a subway. And also think about it, gas company, utility companies, when they if they raise the rate, right? Is there anything you can, fight back? Is there any way you can fight back? I mean, if it is, at least if there's a competition, you can fight back. If, let's say, Coke raises price and Pepsi doesn't, you can switch simply to Pepsi, right? Or vice versa. The more competitors are there, it's the common sense, right? But if it is a monopoly and it's natural monopoly, like utilities, MTA, mass transit. The MTA, subway ride is now $2.75, I believe. So compared to, well, of course, you might say, it's been 30 years, and I mean, when I paid like 50 cents or 75 cents for a subway ride, and since then it's been 30 years, uh, that kind of rate fare increase, isn't that reasonable? We'll have to, that's more than, I mean, obviously, inflation over 30 years is not like, if you simply calculate, uh, it's more than the inflation over 30 years. So uh, even, allowing for uh, a reasonable margin of profit margin, a reasonable profit margin, still it's way more than the uh, reason, fair hike, more, way more than reasonable, fair hike, But think about it. That is, that is the nature of monopoly. Because if they are left unchecked, if they are left unregulated, they can do anything. Because everybody needs, power and gas. And if utilities, raise their uh, uh, rate, everyone is held hostage because there's no way you cannot. You need electricity to uh, light your house, gas to cook and heat your home. Right? Everyone is held hostage. So monopolies are must be regulated, but then they also need to make profit. Right? Monopolies cannot run on. It's not a charity. It's not. They have to. It's not. Pure public service, right? So they have to make profit. So what is the reasonable uh, uh, profit margin? In other words, then what is the reasonable rate of return for regulated uh, industries? And as uh, tool to set rate of return, uh, reasonable rate of return for public utility, right? Uh, uh, capm is the tool for that, right? Now, but however, capm has limitations, and what are the capm's limitations? First of all, um, we capm uses market portfolio. But what is a market? We all understand what market portfolio is. Uh, and we are using S&P 500 as a proxy for market portfolio. But theoretical market portfolio is an elusive concept. Why? Because it has to be a very broad based, right? Because it has to include all financial market, including real estate, foreign stocks, etc., commodities, uh, foreign exchange, so it has to be a very comprehensive and inclusive portfolio, but it's only theoretical because in reality you cannot keep track of all of them uh, through throughout time. Because think about it, it's always in flux, right? Not not the same. It's not like always the same number of assets are uh, uh, there in the broad concept of the market. So because some companies fail, some companies fall out of that market. Uh, uh, Commodities, there are the new commodities that are being added. I mean, generally commodities are, gold, silver, copper, and things like that. There are sometimes, oil, right? Sometimes, even things like, pork belly, uh, wheat, a rare earth, including also there are rare earth, the minerals, rare minerals that are being used for, high tech. So think about it. All-inclusive, comprehensive market portfolio is only theoretical, right? And also, CAPM applies to expected return, not actual returns. In other words, uh, we are using CAPM to forecast or predict the expected return, which is the mean expected return. Actual returns, but expected returns are forecast, and we don't have actually, a forecast is not uh, an actual data, right? Um, so actually to implement or to operationalize CAPM, uh, we have to use index, like, S&P 500, which has a constant 500 uh, companies in it, right? It's not in flux. I mean, 500 companies are 500 companies. I mean, there are five. There may be, some, new entries or some exits, but there are 500 companies. Unlike the theoretical market portfolio, which is constantly in flux in terms of in number of companies that are in there, or number of uh, other elements or factors, which are all constantly in flux. S&P 500 has a definitive uh, number of companies in it. So we have to use index portfolio, and we have to use realized actual returns to operationalize, right? Or to implement actually, And the advantage of the index portfolio is, the composition and rate of return of the index is unambiguous and widely published, right? Because, in other words, something I already said, it's definitive, and the data is widely available. So it provides a clear benchmark for performance evaluation. Whereas CAPM rests on elusive market portfolio, right? Some assets are not even traded, and yet legitimate if it predicts real world outcomes with sufficient accuracy when index portfolio is substituted for CAPM's market portfolio. In other words, we need to use index portfolio uh, to substitute, to replace the theoretical market portfolio in CAPM. Now, so we need to establish that index is roughly equivalent to market portfolio by how do we establish that? Through mean variance efficiency. In other words, if we verify index chosen index is representing full market, and by verifying that the index is mean variance efficient. And that way we can show Sharpe ratio of index model is greater than any other portfolio. And that justifies using index as the market portfolio. Okay. So I'll have to I'll have to cut the video here. I'll stop the video, and we will continue in the next video. Okay, I will see you guys in the next. Stop recording.